As Alex mentioned, I started the early part of my career more focused on the maths. Maths is the language of the gods, and I thought every investment problem could be solved using mathematics. So we had these very complex models of maths and computers and stuff. But I think maybe as I got a little bit older, I saw there was a disconnect between the optimal math solutions and what was actually happening in real life. So, and this kind of disconnect became more and more interesting to me. And the reason behind it was investors aren't always rational. So the maths assumes investors are always rational. They always make the optimal decision. But as I said, I found out over time investors aren't always rational, or at least at the time. I subsequently found out investors are always rational. I just didn't understand their behavior. I became very interested in trying to find out more about this, particularly the work of Dr. Dan Ariely. So he's considered the world's leading behavioral investment guru, if you want to call him that. And that this particular book really changed my life. So he looks at different aspects of investor behavior, and he proves how irrational the investors are, and then how we can use that when we're actually investing. And one of the chapters in the book deals with a topic called confirmation bias, which sounds very complex. But what it actually means is you filter facts and information to arrive at a predetermined outcome. You filter facts and information to arrive at a predetermined outcome. And that outcome might be good or it might be bad. So to put it in a simple way, you're watching the Mighty Bulls play Transvaal or the Lions on the weekend, and there's a high tackle. The one team supporters clearly sees the high tackle. The other team supporters clearly sees it as not a high tackle. But ask yourself, everybody is looking at the same information at the same time, yet they come to diametrically opposed outcomes. And the reason is because we all filter that information. The good news is we all do it. Our kids do it. Our grandparents do it. If you're in America and you're pro-Trump, you'll probably watch Fox News. If you're pro-Clinton, you'll probably watch Clinton News Network. So we all do it consciously and subconsciously. The interesting part is, how does this affect the way that we invest? Does this confirmation bias actually affect us when we invest locally and when we invest overseas? So I just wanted to share some thoughts on it. So if you look at these investments in terms of the South African context, so I think, like everyone knows, the last 5 years have been quite traumatic for South African investors. If you think like any family or any business, there's really one rule of nature: you can't consistently spend more than what you earn. And as a country, that's really where we find ourselves at the moment. So there's a few options that we have to get us out of this mess. Obviously, the first one, as any family is, we try and increase our income. The country can do it by trying to increase growth, more taxes, more money to spend. Other option, we can increase taxes. The problem with that is that we can't increase VAT because of the social implications. We can't increase the taxes on salary earners because you have something called the Laffer effect. So it sounds technical, but it's also very rational. What happens after a certain point, it's no longer worth people working because the taxes are basically so high. So what they do, they actually leave the workforce, they immigrate, or they engage in tax evasion, tax avoidance, or tax revolt, I think is the term that they use. So your absolute revenue from taxes actually starts shrinking. So that option isn't really available to the government. Once again, like any family or any business, we try and decrease our expenses. Same with the government. They can decrease the wage bill, either the size of the public service or the increases. They can also stop the bailouts, which the numbers are pretty large. And then finally, they can stop what I call vanity projects. So stuff like NHI, SAA. We all want to go to the spa, play golf, have DSTV, but sometimes you've got to cut expenses, and it might hurt in the short run. The third option they have, like the rest of us, we go to our bank manager and we go, Mr. Bank Manager, I've run out of money, please may I have some more? But like any bank manager, they're going to look at your income statement, your balance sheet, your assets, liabilities. Based on that, they're going to loan you money or not loan you money at a rate, etc. The problem with South Africa is going to be in dollars. And And it doesn't matter if they go to the Chinese, the Russians, or the IMF, they're going to be faced with the same issue. Lastly, we have what I like to call the Venezuelan effect. So they basically take people's wealth to fund their spending. So you talk about things like expropriation, not just land, property, IP, etc. The talk around the nationalisation of the Reserve Bank, the changing of the mandates, those kind of options. My own view is that we will grow the economy, and I've basically bet my life on that. So don't feel too nervous about that. So I think that pretty much leaves us with South Africa being more looking at the facts, maybe being more pothole than bullet train. Ramaphosa had this great speech, I'm going to build this city in the sky, and there's going to be all these coders, and it's all going to be great. But I think if you look at those facts, you think it's pretty much more pothole than it is a bullet train. But maybe we're getting a negative confirmation bias. I'm not saying that there aren't problems in the country. There are significant problems in the country, probably the most since 1993. But there is another side to the story. So in terms of the valuations in South Africa, you might hear some of the market commentators saying it's very attractive, the valuations are very attractive, etc. What it basically means is if you've got a company valued at 100 Rand, it's now trading at 40 Rand, that 60 Rand discount reflects the risk in the system. So what some people are saying is that risk or that discount does not actually reflect the risk in the system, and there's opportunity going forward. As Alex said, I had the opportunity to work for a US investment firm, and US firms are brutal. They invest for returns. They don't care about anything else. So if I see guys like PepsiCo investing, it gives me hope, because I would assume they have more information than what I have, and they're not going to be putting those big numbers into the country unless there was some certainty of outcome for them. Just as an aside, I was chatting to a friend at my kids' rugby game the weekend. So they've just won a contract, not for one Amazon warehouse, not two, but three Amazon warehouses in Cape Town. So there are stuff that are coming through. We don't hear it in the media, and I love the media, and I love Michael, and he might speak a little bit on that. But those are the stories that we're not hearing in the country. And another good story that I want to tell is we have fantastic companies in South Africa. My kids are very fortunate to attend a school called Cura, and Cura follow a thing called STEM, so it's science, technology, engineering, and maths. And they have these kids. I mean, my 8-year-old kid loves Lego. They're basically coding Lego robots at 8. Last weekend I was doing some homework with him. He was doing first-year statistical terms, means, modes, all that stuff. So we have these companies churning out world-class products. In this case, I'd like to think it's my son. The other things to consider is, as Alex said, I was very lucky to work in the Russian markets and the Central Asian markets. Our press is still free. The legal system still works. The police and the army, despite the inefficiencies, are not aligned to any particular politician or party. So there is some good news in the market. The thing is, it's not portrayed in the media. And what I just want to convey to you is when you're doing your planning with your wealth manager, don't just see the negative. The negative confirms that things are bad. Try and look at the positive and the negative. Get a more balanced view, and then work out your plan on that. And once again, I'm not saying it's everything's unicorns and rainbows. There are significant risks, but have a balanced approach. Don't make decisions based on the fear. What else did we talk about? Yeah, so I think likewise for the global economy, if we look at the news, we probably all think the world is in the worst state it has ever been. That in fact is not actually true. People have never been wealthier or healthier, and there's never been less conflict in the world, which is very contrary to what we see on the news. So about 15 years ago, the United Nations came out with a couple of targets to reduce poverty on a global scale. I think there's 7 over there, and it dealt with income, healthcare, a whole lot of issues around poverty. Every single one of those targets were met way before the target date, and the absolute poverty level, which they had pegged at $1, they're now thinking should be $3. So that's a 200% increase in what they thought poverty was. And again, those things don't always make the news. Other good thing is, we thought we'd have this bipolar world of the Americans on the one side, the Chinese on the other side. We now see the Indian market coming through at 5%. So you've got India growing at 5%. You've got China growing at 5%. Just in terms of the US, I have a bit of experience there. So the small and medium enterprise confidence index, which means small businessman confidence index, is at 40-year highs, and that is what grows the economy, because they employ people. That's what grows the economy. So there are fantastic stories out there. We just don't always hear about it through the media. So what does that really mean for us? So I think all these good news stories maybe hide the fact that the world has changed quite a lot in the last 20 years. We've got new industries, we've got new companies. If you think back 20 years, automation was kind of RoboCop or Terminator type of movie. But automation is real. So one of the issues I was lucky to sit on the global investments committee. And one of the things I always said to them is, we don't really care about automation in South Africa. Labour's cheap. It's not really going to affect us. And then they explained to me, automation is the way that America brings industries back to the States. So the big advantage in developing markets is the cheap labour. If the first world can automate, they bring all those industries back to the US, back to Europe. Those taxes then get paid in the States, they get paid in Europe. So that's why the big drive behind automation. Just as an example, if you can think the Swedes, I saw have perfected a Volvo truck, the big Volvo trucks. They can drive without any, they can drive automated. So you have a truck that's working 24/7, never ever breaks the speed limit, never breaks the law, never deviates, never stops. And those are the things that you're going to be seeing the next 15 to 20 years. Uber, So the other big investment theme that's going to affect us in the next 15 to 20 years is something called Internet of Things. So you'll see it's I, small o and a T, Internet of Things. So those of you that are lucky to have a Samsung will see there's a little icon there called Samsung Connect. And you press on that, and you can connect to any of your household appliances that are connected to the internet. So you can basically open your gate, start your fire, start your stove, etc. But the big advantage, for example, is in Australia, you have farmers. You have to travel. Previously, you had to travel 6 or 7 hours to turn on a tap, drive back, fly, etc. What they can now do is they can go online, open doors, start windmills, start water pumps, and close it. That frees up all their time to be more productive, and brings down those costs. So those are the things that are going to affect us in the future. My favorite is Uber. I don't know if everyone knows Uber or if everyone uses Uber. So Uber started as an app between some friends. It's basically a cab hailing service. And then it really took off. And what since happened is Uber's really taken over from the metered industry, from the meter taxi industry. It's now started affecting the car rental industry, and it's even starting to affect the car sales. So my colleagues in New York and London never own cars. They Uber in the week, and when weekend comes, they'll go and they'll rent a car or an SUV or whatever. So that has fundamental implications for the way that we live our lives, for the car industry, property prices, etc. So there's this fantastic stuff. So if you were looking at this new future 20 years ago, you would have said there's this great company called Nokia. These guys are going to do it. Nokia basically ceased to exist. Samsung's obviously the leader, and maybe Apple following behind. So there's these fantastic industries that are coming to us in the future. There's these amazing companies. It's not all dark. It's not all bleak. And once again, when you sorry, that was very strange.
Machine learning.
Yeah. How much time do I have? 3. So I just want to show you just a few facts, and there's no data mining. I just randomly went. So if you look at this chart here, it's the S&P 500 for since 2009. So you can see there's the great financial crisis, the global financial crisis, and we really thought, and the world was on the abyss of really, really bad things. Since then, we've had a decade of growth. There are periods where it goes down, and that's what I only speak about. So I call those periods the fear. You have the fear, things are going badly, change my plan, go into cash. You know, it's the fear. You start making decisions on fear. Don't make decisions on fear. Have a plan. Speak to your wealth advisors. Stick to that plan. If it's cash, it's cash. If it's global equity, it's equity. But don't make decisions based on fear. You know, consider all the facts. US internet speeds up 400% in the last 5 years, I think. China growth at 5-6%. Chinese car sales. You know, we have this term, the trend is your friend, and you can see the trend there is clearly up. So what does it mean? You're probably going to be driving a whole lot more Chinese type cars in the future, which might not be good news. Just a very high level, you have returns on this axis, you've got risk on this axis. These are all the different asset classes, what we expect in the next 5 years. And the one in particular is this productivity basket. So that's automation, Internet of Things, etc. So I kind of expect this productivity basket to be doing 15% approximately in the next 3 to 5 years in dollars. So, you know, as a previous portfolio manager in quant, I would take that any day of the week. The problem is, which asset class, do you pick that instead of German bonds? Within that productivity, do you pick Google, or do you pick Nokia? And those are the challenges that we have as a team. So just to wrap up, don't be fearful. Stick to your plan. Make sure you have a plan. Talk to your wealth advisor. Ask them about the good and the bad. Don't trade on fear. Thank you.